Debt financing is not just about borrowing money, it is about using the right money at the right time for the right purpose. In this video, you will learn where debt financing actually comes from and how to choose the right source for your business needs. We will break down when to use debt smartly so it works for you, not against you. You will also understand how to manage risk by thinking in numbers, not emotions, so your cash flow stays safe. And finally, you will discover a simple, practical strategy to use debt like a pro by starting small, testing results, and scaling with confidence. In the real world, debt financing comes from places like banks, credit unions, online lenders, or even business credit cards. Each option has different terms, interest rates, and flexibility. For example, a short-term loan might help you buy inventory before peak season, while a line of credit can cover day-to-day cash gaps. The practical approach is simple. Match the type of debt with the purpose. Do not use long-term loans for short-term problems or expensive credit for low-return activities. The source matters less than how well the money fits your business need. Debt works best when it directly leads to revenue or efficiency. For example, borrowing to buy inventory that you already know will sell fast is a smart move. Taking a loan to invest in marketing that has proven returns is another strong use. But using debt for uncertain experiments or unnecessary expenses can quickly become dangerous. A good rule is, if you cannot clearly explain how this money will come back with profit, do not borrow it. Debt should feel like a calculated step forward, not a desperate reaction to problems. The biggest mistake business owners make is ignoring the numbers behind the loan. Before borrowing, calculate your monthly payment and compare it with your expected cash flow. Ask yourself, can my business comfortably handle this payment even in a slow month? Always build a small safety buffer. Also, avoid stacking multiple debts at the same time without a clear repayment plan. Debt is powerful, but only when controlled. Once it starts controlling your cash flow, it limits your decisions and increases stress instead of creating growth. A practical strategy is to start small, test results, and scale slowly. Take a manageable loan, use it in one specific area, and track the outcome closely. If it generates consistent returns, then consider increasing your exposure. Treat debt like fuel for a machine, not like free money. Keep it targeted, measurable, and disciplined. The goal is not just to borrow, but to build a system where borrowed money multiplies your business results. When you reach that stage, debt stops being risky and becomes a controlled growth engine. If you found this video helpful, then please like this video and subscribe this channel to get future videos.